Hello and welcome to the Morningstar series, Why Should I Invest With You? I'm Emma Wall and I'm here today with Claudia Calich, manager of the M&G Emerging Market Bond Fund. Hi Claudia.
Hello.
So it's our Emerging Markets Week this week, and we can't just focus on equities, although perhaps they are the better known way to access the emerging growth story. Fixed income is what we're here to talk about today. Emerging markets bonds were extremely popular a number of years ago. They were sort of the thing that everyone was talking about when interest rates started to fall in the UK and people were looking for a different way to get yield. But since then, there have been a number of reasons, the taper tantrum for one, which has meant that they've fallen out of favour. Presumably, this has actually been quite a good thing for an emerging market bond manager because that's meant opportunities.
Yes, and I think we clearly saw that, as you mentioned, during the taper tantrum, we had a very sharp correction, very substantial inflows going into the asset class that corrected within a couple of weeks. As a consequence, we saw asset prices will have a huge sell-off as managers had to sell the holdings to basically cover redemptions on the funds. I see the pace that we have currently as actually quite good for emerging markets in the sense that the last thing I would like to see is major amount of money coming in just to see the same amount of money leaving if you have any particular headache or headline rather, or any other fears in the market. So I'd rather see small and steady flows as opposed to those big swings that we saw in the past.
We did see about $4.5 billion leave the region, leave the sector rather, emerging market debt in May. But when you look at the numbers, this has meant that obviously with low demand, we have some quite attractive yields. You know, in Turkey, 10-year government bond is around 9.5%, something that everybody in the UK would love to be able to get on deposit, not for some time, I fear. Where are you seeing the best opportunities? Are you attracted by rates like that in Turkey?
Turkey obviously is a difficult situation because they still need to hash out the coalition and the politics in the very near term. They are benefiting potentially from items such as lower oil prices and so forth, but in my view, that's taking a back seat at the moment. So politics will remain critical for countries like Turkey. But instead, I'm focusing on a few opportunities in, for example, in terms of themes. One is the U.S. recovery, strengthening the labor market in the U.S., pushing up wages, which arguably that's something the Fed is worried about. But as an investor, I'm actually happy for a few countries. So the U.S., for example, has a very strong labor force of immigrants from Central America. So countries like Honduras, Dominican Republic, Guatemala, all those are migrants, they send money home, and that's really supporting those local economies. So that's one of the areas that is one of the key overweights in the portfolio at the moment.
And we've mentioned their regions. Is it as simple as sort of putting a pin in a map and saying that's a great place for fixed income, or is it much more about thematics, like you mentioned there?
Yeah, I see emerging markets very much in a theme because you cannot just generalize Latin America. You have some really good and improving stories, and you have some absolutely basket cases. The same thing with Eastern Europe. Asia is also, they're all different in terms of politics, in terms of growth, whether they're commodity importers or exporters. So you really have to take a much deeper dive into the country themselves and see what are the key drivers. So I never really, very rarely, I'll look at a region as a whole. I'll just look at the smaller pieces that comprise that region.
And of course, fixed income investing is a very different thing to equity investing, but the thematics which drive them can be the same. For example, we've seen some countries do very well out of currency weakness when we're looking at equity investment, and I believe you found fixed income opportunities that also benefit from that.
Correct, yeah, so that's the other theme I'm playing in the portfolio, which basically underweight currencies, but also more importantly, overweight some of the corporates that would stand to benefit from a weaker currency. So basically exporters that are gaining from having more revenues in either dollars or euro, depending on the company, but most of their costs being in local currency. So they're actually benefiting quite a bit. So we have a few names. For example, in Mexico, we have an auto part producer. We have Brazilian exporters in the beef sector. Similarly, in South Africa, we have a pulp and paper name. So all of those companies, they're actually doing much better despite the currency weakness. In this case, it's actually with the currency weakness.
And what about the third theme for the portfolio?
The third theme is really idiosyncratic stories, stories that would be much less correlated with what's happening, whether it's in China or in Greece, for example, and much more correlated with its own dynamics, whether it's politics or economics. So countries such as Ukraine, which is undergoing a debt restructuring, Pakistan, Sri Lanka. So those are very much stories that are almost on their own. Of course, those are weaker credits. So if you have a very strong bout of risk aversion. Those countries, temporarily, they would underperform. But on a longer term basis, if you pick the correct countries, you do the homework, there are opportunities to be found. You just have to look very closely.
I mean, you mentioned Greece and China there. They're the two big stories of the week, in fact, probably the year. Mm-hmm. Are you looking for opportunities there, or are you just sort of staying clear?
Greece, for the time being, I'm not. It's obviously it's a very difficult political decision for the Europeans, and as a consequence for investors, it's very difficult to trade those headlines. In terms of China, I have some exposure, but relatively defensively positioned on two corporate names that we're comfortable with. One is a car rental company that basically benefits from the domestic consumption, in this case, car rentals. And the other is a food producer, which is also then very stable demand, given it's on a non-cyclical sector. I'm avoiding the real estate sector or any other companies, SOEs, or companies that could be badly impacted either through the deleveraging process or the slowdown in the economy.
Claudia, thank you very much.
Thank you so much.
This is Emma Wall from Morningstar. Thank you for watching.